Just had a client tell us that they happened to win tickets to a Taylor Swift concert in LA. They got 2 tickets to go there, plus some kind of voucher for hotels. And so I was like, "Are you Taylor Swift fans?" They're like, not really, but it's Taylor Swift and everyone's going, everyone's talking about it, so you got to go. I was like, "That's pretty cool." I think I would go if I got free tickets. So anyone out there, free tickets, I'll take.
Apparently, she's best of the best, huh?
Pulling in some money.
Second to
Taylor
none.
Swift, T Swizzle want to become a client. We will take you gladly.
Wow, would we though?
Yeah, she seems nice. I saw the documentary on her on
Oh
Netflix
no, I did
years
not.
ago.
No documentary here, sir.
She's super sweet. She writes a lot of her own lyrics. She's very much down to earth. She's talking about real world problems
Is she?
and has a pretty super squeaky clean image.
Yeah, she's done a good job.
Welcome, listener, viewer, to episode number 40 of Talk Your Chart. Brett Hurwitz here with Marco Segura. Today is August 17th, and we got a lot to get to today based on what's been happening the last few weeks. I'm going to start the episode off by going through a number of slides that I think paint a picture for me, and I'm going to make a case just like the great Vincent Gambini and My Cousin Vinny made the case, that things are not so bad. I guess what we refer to as the Goldilocks effect, not too hot, not too cold. And so we're going to start with a number of pieces of information that have come out in the last few weeks. First, we'll start off with retail sales. This was released a little while ago, and I highlighted just the main number there, which was June number was up 0.7 July was up 0.7 over the June number and up 3.2% versus a year ago. So very solid retail sales. You can see all the categories there from furniture to cars to clothing to gas and everything. A good solid number.
That's getting ready to go back to school.
Could be some of that, but it's been solid for a while now. Number two, second report we got in the last few weeks, which is the job market. We had payrolls a little under 200,000. That was reported in August for the month of July. Unemployment rate still very low down there at around 3.5%. So again, we've seen the trend come down. We had at one point way too many jobs being created. And now we have a good amount, not too hot, not too cold, somewhere between. People are not losing their jobs. So I would say it's still a pretty good number, right?
Yeah, 3.5%. When does a recession happen? When unemployment's at 3.5%? Never, but they come after. And then that 3.5 jumps.
Well, we will see. The third statistic that came out in the last couple of weeks was GDP for the second quarter. Obviously, that's backward looking, we know. But you had a solid 2.4% number for the second quarter of GDP. So that's 4 quarters in a row. We've had pretty good amounts. Obviously, it's not the 5 and 6% back in 2021 when we were recovering from COVID. But I think we would take in most cases a 2 to 3% GDP growth, which seems to be kind of on average over the last 10, 20 years. Would you
That's
agree
back
with
to
that?
trend 100%.
Okay. So, and the last thing that's came out was the inflation reading for July, 3.2, ticked up a little bit from the 3 in June. But again, way lower than June of last year at 9. It's come down pretty consistently. It's not going to come down every month, but the trend is lower. And we're not too far off from what the Fed has said is their target, which is 2. They've also said they'd allow it to go a little bit higher if it needed. And so I would say, again, pretty good result. Not too hot, not too cold.
What do you make of the recent Fed minutes that say they still think it's too hot and they might not be done tightening? And now you
Exactly.
see a 10-year treasury that's getting to its previous high from last year, right?
Yep, you read my mind. I was going to mention that. I think the Fed has to say that. They have to say, well, inflation is still too high. We got to get it down, because if they stop saying that, then there's a risk of inflation going back up. Everyone expects inflation to come down, but clearly the bond market rates keep going up without the Fed having to do anything. So to me, I think it's the Fed keeps talking tough, rates go up without the Fed increasing interest rates. And so they can now sit back and watch and say, we didn't have to do anything. Rates went up on their own. And now we're done raising rates and can let things settle because we're at a pretty good place right now.
I unfortunately agree with you. I think they have to talk a strong game, and they will not have to raise rates because the market will do that for them. That is the natural phenomenon of the herding behavior that exists in markets. I think it's important to note that although headline came in at 3.3, core came in at 4.7, the one that they watched, the PCE, was at 4.5. So still high, but I agree they're just going to talk at stuff. Okay.
Yeah,
Okay.
I
Okay.
mean, all of this suggests to me that this idea of a cool landing, a soft landing is one that really could happen. Because if we were to look back a year ago on what we thought would happen this year, it was, oh my God, red flags is going to cause a recession. They're moving way too fast. Everything's going to fall apart. So far, we've seen some segments fall apart, and you're going to talk about them in some of your charts of some areas of weakness. But for the most part, the economy is doing pretty good. That Goldilocks of not too hot, not too cold, right in the middle. And I would say this is a perfect job that they're doing. Perfect.
So you're saying perfect for the guy trying to be that guy. All right,
Perfect.
fine.
We're trying
Yeah,
to
look,
we're trying to figure out a moving target and what to do month to month based on information that's in the past and not knowing the future. This is to me as good as it could have gone. And that's why the markets are so happy so far.
yeah, I think so far so good. But there's a lagged effect to this stuff, and something else is going to break.
We shall see. That's your
Something's going to
opinion.
break. Heads up, private credit, heads up, venture capital, heads up, real estate funds that are overly leveraged. It's always leveraged. I just read a book. I finished reading a book called When Genius Failed about long-term capital management. And it's all these fancy, super intelligent people. They over leverage and they bet too big. It's always leverage.
Yep.
Okay, we continue. BH, you have a chart here on the 10-year. Was there anything you wanted to talk about there? Was that was it?
No, just that's the bond market reacting to the Fed saying we're going to keep raising rates, or maybe have to raise rates or keep them higher for longer. Bond
Okay.
market saying, okay, we believe you. I don't believe them. And I don't know if a lot of people do believe them, but the bond market's reacting to with higher rates, and that's going to help cool the economy on its own.
All right, good. So you mentioned I had some charts here, obviously. They're not actually negative charts. Again, I know I have my call for the recession starting at the end of this year. By the way, JP Morgan, at least a subset within JP Morgan, is still calling for rate cuts in September. And by the way, it's August 17th. So we'll see. Goldman's going next year. Again, they're scattered everywhere. It doesn't matter. We'll stick to what we do best,
Zero chance
which
of
is
that happening.
generally ignore the prognostications. So all my charts here, BH, except the last two, I'm corporate focused and then household focused. The first three are corporate focused. Specifically, why haven't higher rates crushed corporate profits? So who knows? Everyone can have a take, but why don't we just kind of look at the numbers? The first chart here is the interest coverage ratios for the average high yield or kind of junk bond company and investment grade company. So basically, do they have enough revenues and profits to cover their debt payments? And what you're looking at here, IG in the blue line are the investment grade companies, the red line are the high yield or junk bond companies. If you look to the right, that's what's measuring the high yield. Look to the left, that's what's measuring the investment grade. And ultimately, forget the numbers here, just look at the trend. They're off these horrible lows from the pandemic, but they've jumped up as they've accumulated cash, which wasn't necessarily fair because they weren't spending it. Now they are. So they're just in a strong position right now. So as of today, rates haven't impacted them. What that means 12, 36, 48 months from now, who knows? But as of right now, today, you're looking at companies healthy. Next thing, margins. Corporate profitability is historically high. It's so high that everyone's saying that they're part of the inflation problem. Not going to comment on that here. But if you look again at the high yield market and the investment grade market, and you look at their margins, profitability is historically high. So again, another healthy sign for corporations. Last piece here that was, go ahead.
I'm just saying, unfortunately, we always talk about this. The chart looks great going backwards. And so that's why the market has done so well over the last handful of years. But, the risk is going forward that it turns the opposite way.
Yeah, and look, bitch, what have we been doing in portfolios for the past month?
Rebalancing.
Rebalancing, selling stock. Why? because markets are up 30% since October of last year. So there you go. That's how you properly meter your risk, by taking advantage when markets move. So the market's supposed to fall at least 14, 15% at least once throughout every 12-month period. That's what history tells us. That hasn't happened. We've only fallen as far as 8% this year. So it would make sense to me if between now and December 31st, the market falls by 10, 15%, because it's supposed to. Cash, same idea. Blue line, investment grade, red line, high yield junk company, so to speak. The cash obviously popped up to incredible levels when they weren't spending during the pandemic. It's come down for obvious reasons. But again, historically, you're looking at companies that have money. So you have operating profits that are covering interest costs multiple times over. Net profit margins are near record highs, and cash levels are historically high. Again, 13 months from now, a day from now, this all changes, sure. But right now, you're not seeing the stress. So that kind of speaks to why, while interest rates have gone through the roof, they haven't totally crushed corporate balance sheets to this point.
Well, but I mean, just to put in perspective, though, there are some pockets of weakness, right? Commercial real estate in some areas really struggling, some malls and other businesses where they're completely empty. You have other companies in the technology world that are struggling. You've got some banks that are struggling to try to keep on deposits as people move money around and buy money market funds. So overall, yes, there's a healthy economy, but there are pockets where it's pretty weak out there.
I get it. There's nuance to everything,
right? Always the case.
We could, yeah, we could get real cynical and then do the other side of all these things. I actually, I don't have that chart with me, but the amount of at least S&P 500 companies that have to refinance their debt, that's not a big percentage of the S&P 500. So all those debt walls that are coming up, to your point, are within very specific areas. And if you look at private markets, it's a little bit worse than in public markets. For now, again, it'll get priced in at some point.
We also just finished second quarter earnings calls, and I think like 80% of companies beat their estimates, higher than the normal average. So again, on average, companies are doing better than they normally do.
Yeah, I know. And I'm glad you said, because they always beat, right? There's a 75% beat rate on average, like historically.
Right, correct. It was like 80 versus 76 versus on average, I think. So 80% beat versus 76, which is normal.
Yeah, I know. They love to set those expectations here and then come in up top. Humans, am I right? Humans. All right. Households. Brett, this next chart, here's what I'm going to ask you. Is this the next massive tailwind for the consumer? You mentioned it, retail sales. You never bet against an American and their credit card and or Amazon Prime account. Is this the next tailwind?
So you're specifically asking, is home equity that's available the next place that consumers start tapping after they've already been tapping their credit card? Got the question?
It's definitely cheaper than a credit card.
Yeah,
well, let's like walk. So I know I brought this chart, but so explain the chart for our listener.
I mean, this is basically showing your mortgage debt in the purple, which is, a lot of people are refinanced, so they've got they've got mortgage debts going up, but again, it's got pretty low rates. Unless you bought in the last few months, you have a low rate and you have probably a low mortgage payment. Whereas the orange, I guess, or sienna, or whatever color you call that.
What did you say? Did you say sienna?
Isn't sienna like a burnt orange?
I just found out right now if it is.
I don't know, but we can strike that.
You could have just said red, but hey, let's go with sienna. Is that like SIEN?
I don't know. Moving on. So the red/orange is going to be your homeowner's equity. So how much value you have in your home that you potentially borrow from. The reason I would not say this is the next place for homeowners to take their money from is that I feel like they would have already taken their money from here, right? If you have to choose between credit card debt and home equity debt, even though home equity debt is variable as is credit card debt, it's lower. So I feel like people would have already taken their money out of here if they had that, if they were going to, is where I would say, versus putting on the credit card, which has a much higher rate, unless they're using like 0% cards.
Yeah, and rolling. So I think that's part of it. I think credit card balances are going up, but people are playing the credit card game of balance transfer, balance transfer, balance transfer. I'd also only push back. I think you're right. You're probably not gonna go on vacation and pull on your HELOC, probably. But the added friction is what probably does it. It's too easy to take out your credit card. It requires paperwork to pull on home equity. But I will say the people that I'm talking to, this is anecdotal, they're not moving. They're just not moving, right? So the 3-bedroom house they want, if they don't have it now, their 2-bedroom will turn into a 3-bedroom, and that's when you're going to see them tap into this. And that becomes momentum, right? That spend, which is somebody else's income, will eventually, I think, be reflected here.
Well, we saw back in 07, 08, where home equity was everyone's friend. And so I wouldn't be surprised if it happens again, although I would hope that some people have learned their lesson from that time and are not going to be pulling out too much from their homes. But obviously, the banks are not going to allow them this time. But I'm hoping they're smart about their decisions this time, smarter than last time.
Yeah, I think underwriting is going to be tighter, but anyways, this is something to talk about. And by the way, asterisk, we are not suggesting anybody fund their spending out of their home equity. All right, let's talk about, oh, this is another one I threw in for you, the credit cards and the home equity revolving balances. Again, you see credit cards have popped up a bit, right? Obviously, they went down after COVID, makes sense. Now they popped up. And home equity revolving, as we just saw, there's a lot of room to increase.
As long as people have a job and as long as they're getting paid well, this was not going to be a concern. If people start losing jobs en masse, that's where this becomes a self-fulfilling prophecy and gets worse and worse and worse for the economy.
Fair. Last 2 charts. I take exception sometimes when people say debt is at all-time highs as a blanket, just kind of nominal statement, because similar to GDP is at all-time highs. Similar to the price of milk is at all-time highs, because it's always going to be more when you compare it to the 1800s or the 1900s or 1975. The figure is always going to be bigger. So to say there's the most debt ever right now, it's like, well, yeah, it's kind of supposed to be that way. It's a relative thing, right? So the first chart is, yeah, we get it, $17 trillion of total household debt in the US. Oh my gosh, it's the most it's ever been. And 10 years from now, it'll be more than that, I promise you. On a relative basis, though, let's adjust it. How does it impact a household's ability to service their debts and to service what they have to spend on? So what we use for that is this chart, US household debt service as a percentage of disposable income. So this is telling you the burden that a person has to pay for things based on what they make, right? To be able to service all that debt. And if you're looking at this, it's at 9.6%. The highs was back during the great financial crisis of 13%, and an average of 1980 to now of 11%.
Not so bad.
Yeah, that's what I'd say. Look, this isn't say, oh my gosh, everything's perfect. This is okay, so they're not super stressed right now. That's all that says. So
Yeah,
again, I'm still calling for the Q4 recession, but yeah,
isn't this the same reason why every time that we talk about how much the government debt is, and then someone either talks about downgrading us or they say there's a risk in there, everyone sort of yawns and is like, so no big deal. Like that's the case for a lot of places.
Yeah, I almost did government debt instead of this, but this was just more fun in my mind. Also, just government debt is different than U.S. debt. Excuse me, household debt. Households have to pay it off. Governments don't have to pay it off. I will tell you, though, that the downgrade of U.S. credit rating, they didn't just cite the amount of debt. They cited the operational follies of our system, right? So they called out the kind of the quote unquote idiots in the room of like, you guys are disorganized. You don't seem to have a very good process relative to the credit rating. Again, the fact that Canada has a higher credit rating than us, I'll leave that one there.
Yeah, I mean they're not wrong, but I don't think it's going to change where I invest my money and where investors invest their money. So,
not a chance, Mr. Horowitz.